You know, when you think about legendary investors like Warren Buffett, it's easy to imagine some super complex secret formula. But what if it's not? Today, we're going to pull back the curtain and use Buffett's own principles as a kind of checklist. We're going to analyze a real company, M&T Bank, and see what we can find. So, you open up a company's financial report, and wow, it can feel like you're trying to read a completely different language, right? There are dozens, maybe even hundreds of different numbers. It's just a lot. And it's so easy to get totally lost in all that data. But what if we had a guide, like a financial detective's checklist, inspired by the way Warren Buffett does things? Something to help us cut through all that noise and just focus on what really matters. Well, that's exactly what we're going to do. We're going to investigate M&T Bank with 4 key questions. Okay, first things first, we absolutely have to know if the business is actually making money. I mean, that's the most basic, fundamental question. You can think of it like checking a company's report card. Is it passing or is it failing? And one of the best ways to check that grade is with something called return on equity, or ROE. Just think of it like this. For every single dollar that shareholders have put into the company, how much profit is that company spitting back out? A consistently high ROE is one of the first things someone like Warren Buffett looks for. It's a great sign of a healthy, profitable business. So, what's M&T Bank's grade? Well, it's 9.91%. Now, a lot of value investors are looking for an ROE over 10%, so this is right there, right on the edge of being a solid B. It shows that, yeah, the company is pretty good at turning shareholder money into actual profit. But hey, one good grade doesn't tell the whole story. We have to ask, right, is this company a straight A student year after year, or did it just get lucky on one test? For investors like Buffett, a strong, consistent track record is everything. A one-time profit spike can fool you, so we got to look at the trend. And here is the trend. This is M&T Bank's 5-year net income growth rate, and it's compounded annually. That just means its growth builds on itself year after year. A rate over 13%, that is really impressive. It shows us not just that they're profitable, but that they have consistent, healthy growth over the long haul. So first check, passed with flying colors. All right, let's move on to our second check. Making a profit is great, but if a company is poorly managed, that profit can just vanish. So we're going to peek into 2 really critical areas: how it handles its debt and how efficiently it actually runs things. So check this out. This is the company's debt-to-equity ratio, 0.68. This number tells us how much the company relies on borrowing money versus using its own cash. A number below 1.0 is generally a really good sign. It means the company actually owns more than it owes. That suggests a more careful, lower-risk way of handling its finances. Okay, so the company isn't drowning in debt, which is great. That's a huge relief. But how well does it use all of its money, both the money it borrows and the money it owns, to make even more money? That's our next big question. For that, we look at something called return on invested capital, or ROIC. M&T Bank's is 1.39%. You can think of this metric as a measure of the engine's efficiency. For every dollar invested in the company, from any source, it generates about 1.4 cents in profit. A positive and stable ROIC like this points to some pretty efficient management. So for our second check, M&T Bank gets a pass. And now for the big one, the price. We've found what seems to be a pretty good company, but is it selling for a good price? Because like Warren Buffett always says, a wonderful company at a terrible price is still a terrible investment. This famous quote right here is basically the heart and soul of value investing. It's not just about finding a good company, it's about buying it for less than it's actually worth. So let's see if that's the case here. Let's start with the price-to-earnings ratio, or PE ratio. Think of it like the price tag for every dollar of the company's profit. M&T's current PE is 12.26, which is just a little bit higher than its recent average of 11.41. So on its own, this suggests the stock isn't exactly on the discount rack right now, but there's definitely more to the story. And here's where it gets really interesting. This is the PEG ratio. What it does is it takes that PE ratio and it factors in the company's growth. Now, a PEG under 1.0, like M&T's 0.62, is often a sign that a stock might actually be a bargain. Maybe it's undervalued compared to how much it's expected to grow in the future. So while the price seems a little high at first glance, its growth could make it a pretty good deal. This brings us to our final, and you could argue the most important check of all. This is the bedrock of Warren Buffett's entire philosophy. It's the ultimate protection against all the things we can't predict, the margin of safety. To put it simply, the margin of safety is just the difference between what a company is really worth and what you pay for it. It's like buying a dollar for 50 cents. The bigger that gap, the more room you have for error and the greater your potential return. It's your cushion. So, how does this apply to M&T Bank? Well, based on one valuation model, the fair value of the stock is estimated to be around $378, and yet it was recently trading on the market for about $219. I mean, that is a huge difference. And that gap, well, it gives us this, a margin of safety of over 42%. This is that investor's discount we've been looking for. According to this analysis, the stock is trading at a really significant discount to what it's truly worth, and that offers a pretty substantial cushion against risk. So let's just quickly recap our little investigation using the Warren Buffett checklist. Is M&T Bank profitable? Yep. Is it well managed? The numbers point to yes. Is it selling at a fair price? Looks that way, especially when you factor in the growth. And finally, does it offer a margin of safety? Well, based on this analysis, a very, very significant one. You see, a simple checklist like this can turn a whole mountain of confusing data into a clear story that you can actually use. But you have to remember, this is just the starting point. It's the beginning of your own investigation. Looking at all these numbers, what's the one thing that jumps out at you? The one number you'd want to dig into deeper, because that's where the real work and the real wisdom begins.